Welcome to the lecture for Chapter 4. If you have not read this chapter yet, I would highly recommend you read it before we go through these slides. There is a lot to take in, but since there is so much to go through, again, I'd highly recommend you read the chapter before we go through these slides. Okay, so remember in the previous chapter, we talked about only recognizing revenues and expenses when they were actually earned or incurred. So, for example, we paid for an expense ahead of time, like prepaid insurance. Or we took cash from a customer before the service had actually been performed. So because we took the cash beforehand, we had to create a liability called unearned revenue. In this chapter, we're introduced to adjustments, and these adjustments are made to the accounting records at the end of the period to ensure assets and liabilities are reported at appropriate amounts. And these adjustments also ensure that the related revenues and expenses are reported in the proper period, as required by those the revenue recognition and the expense recognition principles we talked about in the last chapter. So why are adjustments needed? Well, adjustments needed, like I said before, so we can recognize revenues and expenses when they've actually been earned or incurred, and so we can also true up those balances on our balance sheet for the liabilities and our assets with what economic benefit we have remaining, and in the case of the liabilities, what's actually still owed to someone else. So when we do adjustments, there's going to be an income statement and a balance sheet account affected. So the first type of adjustment is a deferral. And the word defer means to postpone until later. So in accounting, we say an expense or a revenue has been deferred if we have postponed reporting it on the income statement until a later period. So as you saw in Chapter 3, when rent is paid in advance, the expense is initially deferred as an asset on the balance sheet in an account called prepaid rent. So we pay in advance, we keep it on our balance sheet because it's still our money, we put it in prepaid rent. So in this case here, rent is paid on August 15th for September's rent. So we're paying for this rent in the future. And during the actual month of September, that rent, which we had paid for, that rent benefit is actually used up. So at the end of September, on September 30th, when that 1 month of the prepaid rent has been used up, we make an adjustment. And this deferral adjustment involves reducing the asset prepaid rent, recognizing that it's not a prepaid anymore, and then we recognize the actual expense on the income statement at that time. And here are our journal entries. So here we go. We paid $100 on August 15th. That's our prepay. And here's our asset account for $100 prepaid rent. And remember, these are assets, so the credit means it goes down, and that's cash. So cash came out. And then at the end of September, we want to recognize that we've actually incurred the expense of rent through an adjustment. And so now we actually have to expense that rent. Here's the $100. An expense is a debit balance, if you remember from Chapter 3. And now we can reduce that asset prepaid rent by the $100 because we've actually used it up. Now this entry here, the one on the bottom, that's the actual deferral adjustment. That's the adjusting entry. The entry above it, when we actually paid for the prepaid rent, is just a regular transaction. But the rent expense and the prepaid rent, that's the deferral adjustment. I'm just going to say it's the DA. That's the deferral adjustment. It affected one income statement account, which is our expense, and one asset on the balance sheet. So there's our income statement account and our balance sheet account. And that's a deferral. Have you ever heard someone say that when you drive a new car off the parking lot, it automatically starts to depreciate? In this case, they mean that the value goes down. In accounting, we use the term depreciation. Depreciation is the process of allocating the cost of buildings, vehicles, and equipment, any sort of long-term asset, to the accounting periods in which they're used. Basically, we want to reduce the value of assets because they actually get used up. On the balance sheet, we reduce the amount reported for equipment or the cars, but we don't take that amount of depreciation directly out of the equipment or car or any of those long-term asset accounts. Rather, we use a contra asset account to record and keep track of all the depreciation against any of those long-term assets. So I'll just keep using the word equipment here. So we'll use a contra asset account to record all the depreciation against that equipment. The contra asset account, in this case we're going to call it accumulated depreciation, is like a negative asset account, and it's subtracted from the total amount of the equipment on the balance sheet. So here's our example here. This equipment had a purchase price, so I'm going to get my pen here, had a purchase price of $9,600, and because of the cost principle, we recorded at the amount that it was at the original cost, so $9,600. But we had this contra asset account here called Accumulated Depreciation, and as our equipment starts to depreciate in value, we record that amount in that contra asset account so that we can net the depreciation with the original cost of the equipment to get a carrying value of whatever our equipment or long-term asset is. Let's do an example, it'll make more sense. We bought a car with $5,000 that will last us 5 years. So here's our entry. We bought a car, our car went up, it's an asset, that's our debit, and our cash went down, an asset, so that's our credit. And at the end of year 1, we want to recognize the expense of using the car. Now, the car will last us 5 years, so if we bought it for $5,000, and it's going to last us 5 years, then we know that we're going to use about $1,000 worth of value out of that car each year. So we'll record the expense at that time, $1,000, because we want to record 1 year. And we're going to put the credit to the contra asset account, accumulated depreciation. Depreciation expense is an income statement account, and accumulated depreciation is an asset account. It goes on our balance sheet, even though it has a credit balance. It shows the depreciation on our assets. Now, similar to depreciation, amortization is the concept that applies to using up long-term assets that lack a physical substance and have limited period of usefulness. And software is constantly being upgraded, it becomes obsolete. So software has a limited period of usefulness. And to show that some of this usefulness is used up this period, part of the software needs to be transferred to an expense this period. So to show that, we'll do another deferral adjustment. So if we bought software with $200 that will have to be replaced with a newer version in 2 years, then we'll go ahead and record that we bought that software and we paid cash. That's our journal entry. Software goes up, cash goes down. And then at the end of the first year, we want to recognize the actual expense. We need to do that for the expense recognition. We need to record the expense of using that software. If it lasts us 2 years and it costs us $200, we'll use approximately $100 of benefit out of it each year. So then we record our expense of $100, and we'll record the decrease in value to our asset to that accumulated amortization account. That's a contra asset account. It goes on our balance sheet. So that bottom entry there, that is the actual deferral. That's the income statement account we impact, the expense, and the balance sheet account we impact, which is the accumulated depreciation. But we're recognizing the fact that we need to record the expense for something we had purchased already. Now, accrual adjustments are needed when a company has earned revenue or incurred an expense in the period, but have not actually recorded it because the related cash probably will not be received or paid until a later period. So, for example, employees might have a 2-week pay period and don't get paid until the end of the second week. And that's pretty standard for most of us. We only get paid every 2 weeks or maybe even once a month. So after week 1, which ends at the very end of the year on December 31st, we want the end of the year financial statements to reflect the fact that an expense has been incurred, that our employees have worked, and now we need to pay them. Now, we won't pay them until January 7th, but we need to record that expense that they've actually incurred some wages. And we need to record the fact that we need to pay them. Technically, it's not our money. We owe them money for that 1 week of wages, even though we won't pay them till January 7th. So this is our accrual adjustment. On December 31st, employees have worked the week 1 of their 2-week pay period that doesn't end until January 7th of the new year. They earned $500. So we want to recognize that expense. We want to recognize that they have earned $500. It's an expense to us. We're going to have to pay them. And because we're going to have to pay them, it's a liability to us, and that's a payable. So our expense, and expenses have a debit balance. That's just one of those things you'll have to memorize from Chapter 3. Expenses go up, it's a debit. And of course, we know our liabilities go up, and that's our credit. So on January 7th, the employees are actually paid. At this point, we're going to have to pay them for the 2 weeks. So that was $1,000 if they got paid, or if they've earned $500 every month. After 2 weeks, we're going to have to pay them $1,000. We recognize the second week of expense of $500, and we reduce the payable from the first week because we've already recognized that expense. So the actual accrual here is the wages expense and the wages payable, the amount that we recognize that expense for at the end of the period. That's the actual accrual adjustment. So the process of making adjustments is just like what we learned in Chapter 2 and Chapter 3. We analyze the transactions, we record them, we put it into T accounts, we summarize them for each account, and then right after that we can do a trial balance. So we've already done an unadjusted trial balance. After these adjusted entries, we can do an adjusted trial balance. And just a reminder, adjustments aren't made on a daily basis. That would be way too difficult to understand how much value of a car is depreciated every single day. We'll wait till the very end of a period, maybe a month, a quarter of a year, to be able to calculate the adjustments we need to do and then actually post them. So one additional comment here is that these adjusting journal entries never involve cash. Okay, so the last thing is the adjusted trial balance here before we move on to our financial statement. So before we completed our adjusting entries, we had an unadjusted trial balance, and now that we've done the adjustments, we have an adjusted trial balance. So we recorded journal entries, we posted entries to each T account, and we can take those T account balances and we can actually go ahead and apply them into our trial balance. That's all we got to do, take the balances from our T accounts and put them on our trial balance. So as a reminder from Chapter 1, after our adjusted trial balance is done, we can complete some financial statements. Now, typically when preparing financial statements, the income statement comes first because this is our final number of net income. And that net income amount will flow directly into our statement of retained earnings. So first we do our income statement, and we're just taking the amount straight off of our adjusted trial balance and putting them into their proper place on our income statement. It's pretty simple. We just take amounts straight off of our adjusted trial balance and put it into our financial statements. One thing here too, the net income we get from our income statement is the amount that we're going to use here on our statement of retained earnings. Same thing with the balance sheet. We'll just take the amount straight off of our adjusted trial balance and plug them into their proper place on our balance sheet. And we take that retained earnings balance from what we got off of the statement of retained earnings. The last step of the accounting cycle is referred to as the closing process, and this step is performed only at the end of the year after the financial statements have been prepared. And the closing process cleans up those accounting records that we need to close, like revenue and expenses, so they can start over with a new zero balance in the coming year. We're going to transfer the net income or net loss and the dividends to retained earnings, and we're going to establish zero balances in all those income statement and dividend accounts. So here's our journal entry. This is what it looks like. We take the amounts from our adjusted trial balance, the expenses and the revenue amounts, and we offset them. So here in this case, sales revenue has a balance of $12,100. That's a credit balance, so we debit it so we can get a balance of zero. And we do the same thing for all the revenue and expense accounts. And if we have dividends, then we will offset the dividends. In this case, we didn't have any dividends, but we would credit the dividend amount so we can get the balance to zero and put the offset into retained earnings. That's savings account that we keep on our balance sheet. And after posting all those closing entries, the income statement accounts, expenses, and the revenue accounts, they'll have a zero balance. Also, the dividend account will have a zero balance. The post-closing trial balance is the final check that all our debits still equal the credits, and all those temporary accounts have been closed. And temporary just means those income statement accounts. The revenue and the expenses, we want to make sure those temporary accounts, the ones we start over every year with a zero balance, those have been cleared out. Okay, let's go ahead and summarize everything we've done so far. We know that we can prepare and post journal entries and post those individual entries to the T accounts or the ledgers for each account. Then we compute the ending balances for each account. Say cash, we know the ending balance of cash because we posted the transactions and we know how it affects the cash balance. And then we can create an unadjusted trial balance with all the balances for each account. We'll prepare and post adjusting entries. We'll prepare the adjusted trial balance to make sure we're still in balance with our debits and credits. Then we'll create the financial statements from the amounts listed on the adjusted trial balance. And the last thing we'll do here is prepare and post the closing entries. We want to start over with a zero balance for the next year. And then when everything is said and done, we'll do a post-closing trial balance to make sure all debits and credits equal, and we have a zero balance for our expenses and revenues.